I've reached a very important milestone of £500,000 in my investment portfolio. I started my journey in 2009 and it took 12 long years to go from zero to £250,000. But the amazing thing is it took only 3 years to go from £250,000 to £500,000. This is the incredible thing about compounding. The longer you remain invested, the faster your wealth accelerates. In this video, I'll show you my complete portfolio, how it's performed so far this year and since I started way back in 2009. If you stay to the end, I'll reveal what I've been buying recently and also my investing plans for the months ahead. I'll go through each sector in ascending order of performance for the year so far. This is not investment advice and I'm simply showing you my own journey. In the chemical sector, I only have one company, CROA, and it's had a fairly poor year, down nearly 13%. During the pandemic, it supplied a lot of medical materials and equipment, but since then revenue has collapsed. Perhaps it's time now for CROA to start a recovery. We'll just have to wait and see. As I go through the slides, this figure shows the average price change for the year so far in the companies I have in a given sector. It's based on the companies I hold and not the industry as a whole. This figure shows the value of my current holding. This figure is the year-to-date price change, and because CROA is the only company I hold in the chemical sector, it will be the same as the figure at the top. And finally, here is the dividend yield. I have around £7,700 invested in CROA, so I would currently expect to receive dividends of £190 a year. In the oil and gas sector, I have two companies. Both BP and Shell are in the red this year, but they pay some decent dividends at least. This sector is highly volatile, so expect a bumpy ride if you own oil stocks. With BP falling so much this year, I'm tempted to buy more, and the only thing stopping me is a simple fact that I own quite a lot of oil shares already, and I don't want it to dominate the portfolio too much. Further falls might still tempt me, however. I'll be holding for now, but will be keeping a watchful eye on the share price. In the mining sector, I have just one company, Rio Tinto, and at the time of this video it's down around 10% this year. Rio is very dependent on the fortunes of China, and with the economy in a bit of a crisis at the moment, Rio has suffered too. But just like oil, mining is highly cyclical. If you have the patience to wait for better days, then Rio might be worth considering. There is a very decent dividend yield of 6.4%. In the renewable energy sector, I have just one company, Greencoat Wind Energy. It's also had a pretty poor year, down around 7%. Wind energy generation has been lower than expected, and this has dented profits. Despite this, the dividend yield is very impressive indeed, and I'm happy to hold this one for the long term. In the utility sector, I have three companies. These two are in the green at least this year, and they pay decent dividends. Earlier in the year, National Grid tapped its shareholders for extra cash in order to upgrade its infrastructure. I've held these two for well over a decade. We all need electricity, and I can't see these two going bust anytime soon. The third company is United Utilities. Water has not fared so well recently and has been in the news for all the wrong reasons. In terms of performance, it really is treading water, up just 0.6% at the time of this video. In the pharmaceutical sector, I have two absolute giants. AstraZeneca is leading the way here, up 8% this year. But GSK has the higher dividend. Whatever the state of the economy, we all need to buy medicines. If you find these videos useful, then please hit the like button and I'll continue to bring you these updates. An exchange-traded fund now, and this one tracks the FTSE 100 index. It gives you exposure to the biggest listed companies in the UK, all in one share. The price has risen 7.5%. On top of that, there is a dividend of almost 4%. Now onto my global ETFs, which are up an average of 10%. VWRL gives me exposure to thousands of companies across the globe. VHYL does a similar thing, but focuses on companies paying higher dividends. The capital growth, however, is not as good as VWRL. My third company is VEVE, which focuses on the developed world only. There is quite a lot of overlap with these world ETFs, and I'll definitely do some consolidation in my next portfolio spring clean. I won't be selling this one, however. VEVE is definitely here to stay. In the insurance sector, I only have one company, Aviva. It's had a decent year, up 12.7%, and just look at those tasty dividends of 7%. Not bad at all. I've held Aviva for around 15 years, and it was actually the first company to ever pay me a dividend way back in May of 2009. They say the best time to invest was yesterday, and the next best time is today. So if you want to start the ball rolling on your own investing journey, then Trading 212 will start you off with a free share worth up to £100. Just click on the link in the video description. In the food and tobacco sector, I have 3 companies, and what a year it's been for these two. With tobacco companies pushing hard with their next-gen products, this particular part of the business is showing a 17% rise in yearly net revenue. Dividends are huge too. The food product specialist Tate & Lyle is also in positive territory, but if I'm honest, I'm not too impressed. Is it time perhaps to give Tate & Lyle a chop from my portfolio? Let me know your thoughts on this one. In the consumer goods sector, I have 3 companies. Very mixed fortunes for these two. Diageo has not really recovered from falling sales in Latin America, but Unilever has been on a bit of a roll, and I've been buying more shares hoping to tap into this momentum. And just look at Haleon, up a very impressive 20%. Haleon sells a range of consumer healthcare products and was spun off from GSK a few years ago. The dividend yield is low, but it's been rising fast, a company to watch for the future. Next is my S&P 500 ETF, and it's up 14% this year so far. With its small dividend, I like to keep this one outside the ISA and my higher dividend payers inside. This is one of my favourite ETFs, and I've been buying very aggressively over the last few years. In the brokerage services, I have 2 companies. Both IG Group and the London Stock Exchange have shown decent gains this year. IG Group is a FTSE 250 company. It pays a decent dividend of 5% and the business has been growing strongly. The London Stock Exchange Group only pays a dividend of 1.3%, but it's a high quality business and has a brilliant track record when it comes to generating wealth for investors. Now we come to my top 5 performers, and in the house building sector I have just one company, Persimmon. After a bit of a rocky patch, the housing market appears to be stabilising, and Persimmon has done very well this year, up 19%. There's also a dividend on top of 3.7%. At number 4 is the information technology sector, and I have 2 companies. Both are benefiting from the rise in AI, with a share price growth of 20% this year. Fairly low dividends from these two, and I like to keep them outside the ISA. Unfortunately, there just isn't enough room to keep everything inside. At number 3 is the retail sector, and I have just one company, TSCO. It's up 21.8% this year. The company is focusing on price, quality and innovation, and there's a not too shabby dividend of 3.4%. It's been a great year so far for TSCO. My second best performing sector this year is banking, and I have 3 companies. Barclays was the first share I ever bought way back in 2009. It's up an incredible 45% this year. HSBC is also in the green, and it pays a very tasty dividend of 7.1%. I also own shares in Lloyds, and the shares are up 23% on top of a nice dividend of 4.9%. The banks have clearly done well, but the top spot still belongs to defence and aerospace. BAE Systems are up 12%, but just look at Rolls-Royce, up an amazing 76% this year so far. Their profits have been rocketing since the end of the pandemic. Rolls-Royce doesn't pay a dividend at present, but that may change in the near future. Now for all my purchases over the last 3 months. With my portfolio currently paying dividends of around £1,380 a month, I don't always have to put new money in to buy more shares. Most money this quarter has gone into my Developed World ETF. Just over £2,000 has gone into the S&P 500. I've put 1,800 into AstraZeneca and Diageo, and 1,000 into VWRL and Unilever. As I tend to be a buy and hold investor, there have been no sales this quarter. Every month I reveal what I've been buying and selling, and you can be notified the moment I release my next video by just giving that subscribe button in the bottom right of the screen a quick tap. And now my plans for the months ahead. Firstly, I intend to add more to my S&P 500 and develop world ETFs. Yes, I know there is a lot of overlap, but I'm happy with that for the time being. I've still got a few more AstraZeneca shares to buy, having sold some to take up the National Grid rights issue earlier in the year. I'll hopefully be piling into 3i in the not too distant future. There are 3 reasons I'm doing this. Firstly, the shares are up nearly 200% over the last 5 years. Secondly, just look at how the company has been growing the dividend over the last 10 years. Thirdly, 3i pays its dividends in January and July, and those months I tend to have lower dividend payouts. So buying 3i will give those months a bit of a boost. And finally, I'm definitely going to keep a close eye on BP. If it suffers any more big falls, then I might be tempted to snap up a few shares at cheaper prices. Cash in the portfolio currently stands at just over £3,800. Now for the portfolio performance this year. At the end of 2023, the portfolio stood at 415k, and at the end of September 2024, the portfolio has finally broken the £500,000 mark. £23,700 from my wages has gone in this year, giving me a net gain of 65k. That's a 15.7% return over the last 9 months. I'll now compare this year's performance of the portfolio with other indices, and to do this fairly, I'll strip out any dividends I've been paid so far this year. With dividend payments subtracted, the average share price growth is 12.5% for the first 9 months of the year. You can see in this table the portfolio has outperformed the FTSE 100, 250 and All-Share Index. It's even beaten the All-World Index, but it hasn't beaten a typical S&P 500 ETF. As you saw earlier, I've been adding a lot more into US companies via my ETFs, and I'll continue to do so going forward. Now for my overall performance since I started in 2009. I made plenty of mistakes in the early days as I was learning the hard way, and all my figures include everything. The total amount I've put in from my wages since I started is 270k. But I didn't put this all in one big lump sum. I only started with £5,000 at the time and then proceeded to drip feed in spare money each month. If I had been able to put such a large sum in at the start, my gains would have been much greater. And yes, I would have done much better if I invested in an index tracking ETF from day one. But they were not mainstream back then, and I was limited by my platform to buying individual UK companies. As you have seen, the value of the portfolio stands at just over 500k, giving me a current net gain of 234k or 86%. Many investors will have done better than this, of course, and I'm only showing you my own journey. Not only is my capital growing, but my dividends are too. In 2009, I was receiving just £1 a day in passive income, but this year it's reached £50 a day. To see that incredible story, then click this video here.